let's get started. Hello, everyone, and I want to welcome all of you to today's webcast. Our webcast today is looking at best practices in new loan marketing, featuring research by Comperemedia, along with a great client case study from Service Credit Union. So we've got a really great topic today. We think it's really timely considering just the flood of deposits that have been flowing into financial institutions over the last year or so. We know everyone's trying to make new loans and really grow their loan portfolio, so we think this is just hopefully a topic that you'll find timely and that you can put to use. My name is Al Fontova, and I am a Senior Product Manager here at Harland Clarke Marketing Services, and I work with pulling together quite a few different marketing solutions that include everything from direct mail, email, contact center, and database marketing to help our clients produce better marketing programs. So again, I'd like to welcome all of you today. We've got just a great turnout. This is a record event for us, attendance-wise. So I think we are off to a great start. Let's talk about the agenda and what we will cover today. The first thing that we'd like to do is do a quick audience poll, which we'll launch here in a minute, just to get some feedback from you guys and understand what you're doing with your new loan program. So we will kick that off in a minute. We will then introduce our speakers. We have 3 of them today. We will then go ahead and look at research from Comperemedia. We will have a quick presentation about 10 strategies that you can look at to help you grow your loan portfolio. And then we'll look at our case study from Service Credit Union. And then last but not least, we'll go ahead and have a Q&A session at the end of the webinar. So let's go ahead and launch our poll here. So if you all could be so kind as to go ahead and complete the poll, we'll just take a few minutes and do that. And while you guys are answering the poll question, and our poll question today looks at cross-sell and understanding how important cross-sell programs are to you in marketing new loans to your account holders. So if you can be so kind and complete that poll for us, that would be great. In the meantime, just a few housekeeping questions about our webcast today. So first question we always get is, can I get a copy of the presentation, and will a recording be made? Yes, that will all be made available to you. Look for an email from us coming out probably tomorrow that will have a link to a web page where you can go ahead and download the presentation. All the materials that presented today will be made available to you. And then we will also have a recording of the event in case you want to go ahead and review it or share it with your colleagues, possibly. I mentioned questions, so at the end of the session today, you can ask me or you can ask our panelists any question that you like. And the way that you can do that is if you look to the right of your GoToMeeting application on your screen, you'll see a question box. So you can go ahead and type your question in there, send it to us, and we will answer it for you. If by chance, we have too many questions, which happens quite a bit during this webcast, please know that I will capture your question and I will circulate it to our panelists, and we will send you an email in the next day or so with a response. So if we cannot get to your question today, please know that we will make every effort to answer that for you. At any time during the webcast, if you'd like to contact me, just send a chat message to Al Fontova, and I will go ahead and reply and take care of anything that you need. So that's our housekeeping items. Let's go ahead and see what happened with our poll. Let's go ahead and share those results. So our poll question today looked at how important is cross-sell in marketing new account holders, new loans to your account holders. And it looks like for close to half of you all, cross-sell is a critical component of that strategy. Very interesting. Susan Wolf from Comperemedia will show you some results, some research about how important cross-sell is to a lot of folks out there in marketing this program. So it looks like, for the most part, most of our audience is engaged in cross-sell. Very interesting. And then there is a sizable segment of people who looks like they're very focused on new customer acquisition. So again, very interesting research results here. I thank you all for participating. So let's go ahead and get started. So the first thing I'd like to do is have our three speakers introduce themselves. So Karen, if you can be so kind as to introduce yourself and let us know what you do, that'd be fantastic.
Thank you. My name is Karen Benedetti. I'm the Vice President of Marketing at Service Credit Union. We are a $2 billion credit union. Our membership base is in the state of New Hampshire and also military members around the world. I've been doing financial services marketing for about 30 years, mostly previously banks, and now last 7 years or so credit union. And some cases I've run just the consumer loan marketing. Now I'm running marketing its entirety. So I look forward to this webinar and working with you and sharing some of our programs at Service Credit Union.
Thank you, Karen. My name is Stephen Nikitas. I am a senior strategist with Harland Clarke. Much like Karen, I have about 30 years of marketing and retail experience under my belt. I have been with Harland Clarke now for about a year and a half. Prior to that, I was the marketing VP at about a $3.5 billion financial institution in New York. Before that, I was the retail director at about a $3 billion institution in California. In my role at Harland Clarke, I work with dozens of financial institutions around the country, helping them to implement marketing programs aimed at helping them to grow and prosper.
Thank you, Karen and Steve. My name is Susan Wolf. I'm VP of Financial Services Research at Mintel Comperemedia. I've been with Mintel for 11 years now. Prior to Mintel, I worked in marketing and communications. And I think with that, we're ready to get started. I'm going to kick it off and talk about some strategies that we're seeing in direct marketing for mortgage and loan products. And hopefully a lot of you who are on the phone with us today are familiar with us, but just in case you're not, we're a market research firm, and we monitor direct marketing in both the U.S. and Canada. And we do that by tracking 4 different channels: direct mail, email, online, and print, and we do it across consumer and small business markets. We cover 9 different sectors, and we do that by using 2 types of panels. We use a rolling panel, and we also do a static panel. So today, I'll start with a quick industry overview, and then I'm going to take you through the marketing approach across 4 different loan types, and then we'll wrap up with some key takeaways before I turn it over to Steve. So we'll start with our overview. There's a number of factors that are impacting lending, and I don't think that these will come as a surprise to any of you. But first, we've got the employment. We've got a high unemployment rate and weak job growth. That's combined with the real estate market, where we have slumping home prices, and a lot of consumers are currently underwater on their mortgages. And all that has caused a cautious state of mind on both the part of the consumer as well as the banks. And with the recession and the current state of the economy, we've seen direct mail plummet since the recession. The direct mail, I think, really reflects the state of mind on both the part of the banks and the consumers. You can see in 2011 that we saw a slight increase in the direct mail marketing, but that was largely due to the further drops in interest rates that we see. And then all of this is complicated by the fact that consumers really just want the lowest cost loan, so lenders compete largely on price. The marketing that we see in the Comperemedia database really places heavy emphasis on the loan rates and how rates are at historic lows. So we've got all these factors combined: the economy, the mindset, and the price competition, and that's really making the job tough for marketers and resulting in little differentiation in the marketing. But I think the bright spot is that there's some opportunities. I guess in some more bad news, loan production in the mortgage space isn't really expected to get much better, and that's something that we're expecting to see across all loan categories. In the mortgage space, there could be a slight increase in originations, but the refinancings are expected to drop, which is bringing that overall total down. But again, I think the bright spot for marketers is that because the space isn't overly cluttered right now, there's some opportunities to stand out from the competition. One way that banks are approaching that is that they're really taking a relationship banking approach across all products in an effort to both increase revenue and also make each customer more profitable. So that means adding loans to a customer's suite of products or trying to sell other products with a new loan. And that's really just part of the overall relationship banking strategy that we're seeing. Some ways that they're doing that is offering preferred pricing, rewards, and benefits on other products such as free checking. So the story that I have today is primarily a cross-sell strategy, trying to sell existing, say, checking customers on a new loan, or in the case where it's a brand new loan, they're also trying to sell other banking products and services at the same time. And as we move through the different categories, I'll show you some examples of how that's being done. So the first category we'll review is mortgage. The key themes that we see here are price, as I've mentioned. The majority of the offers that we see are for refinancing. We see lots of mentions of low rates in terms of historical low rates, and then we also see a lot of marketing of the HARP program. I already talked about the relationship banking. It's a cross-sell strategy, and there's discounts that are provided for that. And then we also see a lot of consistency in the marketing in terms of the message and the creative. It seems that when lenders find something that works, they really stick to that and they don't deviate from that. In terms of the type of mail that we see, 8% of all the mail in the mortgage category is cross-sell. It's important to remember that there are two types of companies that we track in this space. The first are companies that only do loans, and then we also have the banks who are doing a full suite of banking products. So where this plays into the space is that the mail from the lenders tends to be primarily acquisition, which is driving that low overall cross-sell percentage. But among the banks, particularly the top lenders, the mail skews toward cross-sell. And you can see that roughly half of what Bank of America, Wells Fargo, and Chase are doing is a cross-sell strategy. The other thing to keep in mind here is that a lot of what we're seeing are refinancing offers, obviously done largely to keep existing customers. You know, basically they don't want them refinancing with another bank and leaving the bank. And again, I'll show you some examples of that. When we look at the percentage of offers that are refinancing, it's running about 75%, and you can see that in the purple line there. The majority of the mortgage offers are for refinancing. So now let's jump in and take a look at some examples. This first example is from our life cycle panel, which is a static panel of consumers who send in their direct mail and email. And the nice thing about this panel is we can track what they're getting over time. So this first example is a Bank of America customer, a mortgage customer, and they've aggressively targeted this customer to refinance their mortgage that they currently have with Bank of America. So between July and September, Bank of America sent this customer 5 different offers. You can see 2 in July, 1 in August, and 2 in September, and they're all for refinancing the existing loan. The offers touch on those key themes I talked about in terms of the price, low rates, saving money, lower monthly payments, but it also references the existing relationship, focuses on how there's a local office that they can go to. Bank of America will review the different options together with the customer. And then they also talk about how easy the process is, and that's all part of their clarity commitment that they're offering. And then in the postscript it says, call us even if you're working with another lender. So they're really working hard not to lose this customer. And why are they doing that? Well, on this next slide, you can see that this same Bank of America customer is being targeted by a very large number of other companies to refinance as well. So the numbers in the green boxes represent the number of offers by company by month. And you can see that between June and March, this Bank of America customer received anywhere between 1 and 4 offers for refinancing. Next, we'll look at Chase. This is an example of the Chase exclusive offer, which gives mortgage customers 1% back when they enroll in automatic payments. The requirements are that the customer must have a checking account before the loan closes, and they have to enroll in auto payment within 60 days of the loan closing date. And then if we take more of a macro view, using our life cycle panel again, we can see that the Chase customer that received that offer appears to have started the relationship as a Chase credit card customer, which is evident based on the customer credit card mail that this particular panelist received. So this is, I think, a good illustration of Chase's cross-sell initiative. Then the bank moved to trying to sell the customer into a savings account, which started in August and went through March. And then in October, they started to encourage automatic payments for their mortgage, that they were offering a $25 cash incentive for setting it up. And then in December, they started offering the customer the 1% back offer up to $500 a year. And with that offer, the auto payment has to be from a Chase checking account. So again, there's this idea of cross-selling products. Fifth Third has what they call their Homeowner Plus Value Package. It provides a mortgage, and then with the mortgage, the customer also gets a credit card where they earn reward points that they can apply to the mortgage. For every 2,500 points that the customer earns, they get a $25 credit applied to the mortgage. They also get a $100 statement credit when the mortgage is open. And it also includes a checking account. When the customer does auto payment, they would get a 0.5% discount. And then obviously they get a debit card with the checking account. Wells Fargo is also reaching out to existing customers. Their offers differ a little bit. They're somewhat softer, rooted in the customer service that the customer can expect, and also a lot of references to the current relationship. They focus on their low rates, the benefits of refinancing, and they're really aggressively promoting the FHA and HARP options. And with that, we'll move into home equity. The key themes that we see here are financial management, a home equity product for control over finances, a way to provide a safety net, or just accommodate any unexpected expenses. It can be used for purchases, mainly home improvements, but we see some references to other things like college. And then again, the focus on price, the low rates, and it's the best option compared to, say, a credit card. In this category, about 19% of all the mail is cross-sell, but you can see that Wells Fargo and Capital One are much higher than that. That's mainly because Wells Fargo has such a strong cross-sell strategy across all products, and then Capital One is mainly cross-selling to its credit card customer base. But then beyond that, the banks seem to be taking more of an acquisition approach, using the products to acquire new customers. About a third of the mail from Citizens, PNC, and U.S. Bank is about acquiring new customers. This example is from Citizens RBS, and it's also from our life cycle panel. Citizens sent home equity credit line and loan offers to new customers. The offer encouraged the prospect to open a Circle Gold checking account at the same time and also have the loan payments automatically deducted. So that's an indication that it was a new acquisition rather than an existing customer. But we did also see this almost identical piece go to existing customers, again, because we're trying to encourage that auto payment. And then if you look at the chart in the middle, you can see that Citizens was aggressively targeting this panel with the same offer between June and November. And the panelists also received a lot of checking offers from different banks, including Huntington, ING, and Fifth Third. So obviously they were a target for deposit products. And they did receive 2 unsecured loan offers from Discover. Capital One is mailing to current credit card customers, but they're trying to get customers into banking products. So obviously a shift from their monoline approach of a couple of years ago. The piece says, you trust us with your credit needs, and as a full-service bank, and then it goes into more detail about what they can provide as a bank. A lot of the offers that we track touch on a number of themes, not just one. And this offer from Capital One is a good example of that. It talks about a home equity loan as a safety net, how it provides flexibility, but also talks about how it can fund purchases such as home improvements, college, and that can be done either now or later. The panelists also received other offers from Capital One for unsecured loans, an unsecured credit line, and a checking account. So this really supports the idea that the bank is trying to expand the relationship beyond just the credit card and into those banking products. This example is from Chase. They are offering a 0.25% discount if the customer opens a checking account and does the automatic payments. But this same offer also goes to existing customers. The fine print says you get the discount if you have or open a checking account. U.S. Bank sent offers with a 3.99% APR, but that rate is only good if the customer has a U.S. Bank checking package. And that package includes a checking account, a money market account, and a credit card. It's positioned as a sound financial solution. It's the best credit choice. It's a way to meet spending needs. And it also talks about the strength, safety, and security of U.S. Bank. So again, trying to introduce banking services to a potentially new customer. And then Wells Fargo is doing something similar. They are providing a 0.375% discount with their PMA account, and that's their highest tier checking account. Again, it requires auto pay. They focus on the low interest rates, the low monthly payment, and again, it's better than other types of credit card. So now we'll shift from mortgages and home equity products and look at auto. 17% of the mail in this category is cross-sell. And again, you can see that Wells Fargo has that strong cross-sell strategy. Capital One is, again, cross-selling to its card member base. And then PNC does about a third, and U.S. Bank is really taking an acquisition strategy. Wells Fargo, again, is trying to get the customer into a PMA account. They're offering up to a 0.5% discount, and the loan balance will count as credit toward the PMA package. They talk about the bank's benefits and go over the interest rate and the savings account. Fifth Third is also doing auto loans. They sent this particular offer, but it's only good if the customer meets certain qualifications. The current auto loan has to be with Fifth Third. The customer also has to open a Fifth Third checking or savings account and then make automatic payments through that account, and that account must be open for the entire term of the loan. So a lot of what we see in this category, like the mortgage category, is for refinancing, and this piece is for refinancing. business is taking an acquisition approach, but they're trying to cross-sell the other banking services with the loan. The copy in the offer says, we invite you to experience everything we have to offer. And then the postscript says, we can also provide you with the checking, savings, and online banking options that are right for you. And then finally, we'll cover the unsecured loan category. In terms of the key themes, debt consolidation is really the number one theme that we see here. They talk about the low rates, and it's the best credit choice compared to a credit card. Aside from debt consolidation, the spending offers cover a variety of things. The next most common one would be home improvement, but then we see a lot of references to unexpected expenses. And again, we see a lot of consistency in this category in terms of the creative pieces talk about the amount and the term most frequently. 20% of all the mail in this category is cross-sell. And this category, more than any of the others, is really dominated by the loan companies rather than the banks. At the top there, we've got the top credit card issuers, and they're really driving a lot of the cross-sell activity here. Capital One, Discover, and Citibank account for 75% of all the cross-sell activity, even though Citibank overall doesn't do a lot of cross-sell. They're mainly doing acquisition. And then Wells Fargo, U.S. Bank, and Bank of America are really doing very little cross-sell here. And that's because unsecured loans are really a standalone product. When we look at our panel, 20% of all consumers received an offer for a deposit product. But of the consumers who received an unsecured loan offer, only 10% of them received a deposit offer. So my main point here is that the unsecured loans are primarily a standalone product. For the most part, if banks are offering someone an unsecured loan, they're not necessarily interested in them as a deposit product customer. Again, that's not to say it's not going on, because Discover, Citibank, and Capital One do quite a bit of it. These are examples of typical offers that we see in this category. The one on the left is from Citibank, or One Main Financial, and they're responsible for 27% of the estimated mail volume that we track. The offer is pretty straightforward. It has a loan amount. It says that it's either pre-selected or pre-approved. They really focus on the fast turnaround time. In some cases, they promise same-day processing, and then it's a very easy three-step process. And the B of A offer has some similar attributes. It's pre-qualified. They focus on the fast turnaround time, but it also includes a table, which is very common in this category, where the recipient can pick the loan amount and the term, and then that dictates the monthly payments. Wells Fargo is one bank that is doing unsecured loan offers. This particular one, the focus is on debt consolidation, but it's a slightly different tone than a lot of the offers that we see. It's softer, it's a little bit friendlier, and most likely that's because it's going to an existing checking account customer. The other interesting thing about this is that it offers an incentive. The interest rate discount is doubled on loans that are applied for within a certain time period, and that actual discount depends on the checking package that the customer has. This is an example from Capital One. They're one of the top mailers. They rank 7 in terms of estimated mail volume. And as I mentioned, they primarily cross-sell unsecured loans to their credit card customers. Their primary message here is loan consolidation, but they also mention home repairs, auto purchases, or just any unexpected expense. And so that wraps up our review of the loan categories, and I'll just give you some key takeaways. First, the cautious state of mind on the part of both the consumer and the banks has suppressed activity, and we expect the marketing activity to continue to be suppressed. But really the key story is cross-sell, and that's mainly because banks are taking a relationship banking approach to the loans. And the refinancing offers really dominate both the mortgage and the auto loan category, which is in an effort not to lose a customer. So it's not so much about acquiring a new customer, but preventing customers from leaving. And then with that, I think it's time to turn it over to Steve.
Thank you very much, Susan. Good afternoon, everybody. So as I mentioned during my introduction, I am a senior strategist with Harland Clarke. I have been on board now for about a year and a half. And prior to that, I have many years of bank marketing and retail experience. And the information I wanted to share with you today is really revolving around my observation of best practices that I see going on out there in the industry. I currently work with several dozen financial institutions, banks and credit unions. Sizes range all over the place, some $150 million asset financial institutions, others several billion in size. So what I wanted to do with you today over the next 10 minutes is share with you really 10 of the key things I see going on out there as ways to help generate more loan activity. And first and foremost, it's leveraging business intelligence. We all know we've got lots of data at our hand. Our industry is famous for the amount of data that we have. But one of the things I'm seeing out there is those institutions that are utilizing their MCIF systems seem to be the ones who by far are having the most success. I also see a lot of financial institutions out there who may have an MCIF system, but unfortunately are letting it gather dust. So those FIs out there who are utilizing their business intelligence, identifying their account holders, whether they're members or customers, and identifying where their best opportunities lie, putting that into play, and then developing strategies to reach out to those particular account holders, the right account holder, via the right channel, the right message, the right offer. All in all, what I see is those institutions that are leveraging business intelligence are making the most effective use of their marketing dollars. Second key point I see is oftentimes marketing and retail are unfortunately not on the same page. I see lots of disjointed marketing efforts going on out there where marketing is focused on getting account holders in the door, whether they're existing or new, and oftentimes when those account holders or prospective account holders walk in the door, oftentimes I see a disconnect between the promotion and what retail is expecting. Oftentimes retail is unaware of what the expectation is unaware of what the initiative is, and so there needs to be better cohesiveness between marketing and retail. Both certainly need to be on the same page. Both need to be focused on covering selling opportunities. Marketing, as I like to put it, should solely be focused on getting people in the door. Once they get in the door, retail should be focused on making sure that they're further communicating the information that marketing is promoting relative to loan opportunities and closing that selling opportunity once that existing account holder or prospective account holder is sitting across the table from them. At the same time, I find that those institutions that have goals for loan growth and are actively measuring and holding everyone's feet to the fire relative to achieving those particular goals are the ones who are most successful with growing loans. Third point, we need to make somebody responsible for loan growth in itself. I don't think anyone would be surprised by this statement, but let's face it, we are an industry that is organized and managed around product lines. And oftentimes when it comes time to grow loans or initiate a program focused on loan growth, oftentimes we're turning to the lending department. What I see is those financial institutions who are really focused on taking a marketing-centric approach to loan growth, who are really focused on making marketing, in effect, their chief experience area, are the ones who are having the most success with growing loans. We need to tear down the silos. We need to establish lots of collaboration between retail and lending, and we also need to make sure that we've got IT on the same page with us. In my experience, oftentimes I see and hear from marketing and retail people that they may have tremendous initiatives that they're about to deploy, but sometimes the roadblock takes place in the IT department, where we all know that they've got plenty on their plate. But those organizations that are better able to tear down those silos between lending, retail, marketing, and ensure that IT is on the same page are the ones who are most successful. And going back to our prior discussion about making sure that we are setting loan targets for growth, living to it, making marketing responsible for that, and sometimes you have to be careful what you wish for, because if marketing is responsible, they're certainly going to be the ones who have to experience any of the pain that might come along as a result of not achieving those particular goals. Fourth point, we need to make sure that we are building relationships and loyalty from the very get-go. Those organizations that have implemented onboarding programs, and it seems like in the last 4 or 5 years, onboarding has increasingly become a key focus among a lot of financial institutions. Those seem to be the institutions that, from my perspective, I see the most loan growth. We know from studies, from experience, that 75 to 80% of all cross-sale opportunities take place within that first 90-day or 3-month window of a new account holder's relationship. We also know that there's a lot of attrition going on among new account holders. On average, we see 3 out of every 10 new members, new customers who are establishing a relationship with us this week are not going to be with the financial institution a year from now. So these onboarding programs are turning out to be a great way to deepen the loan relationship with new account holders, identifying where, let's say, outside loan opportunities may exist. Customers coming in may be driven to the financial institution because of the desire for a low-cost checking account. We certainly know that that is taking place increasingly in our industry these days. So while that particular customer or member may have turned to our financial institution simply for a checking account, you can be pretty well assured that there are loan opportunities out there. And if we're not onboarding those new customers and new members, we're losing an opportunity to bring those relationships in-house. I wanted to show this particular slide because I thought it was very interesting in the sense that I sometimes hear financial institutions say that they're concerned about the account opening process and continuing the conversation for fear that they will be intrusive on that new account holder. This is a study that was conducted by J.D. Power. It is a satisfaction study. The blue bars measure activities that are taking place within financial institutions. So if you go all the way over to the left, what we find is obviously 100% new account opening activity taking place. And then we see the communication process start to fall off. 63% are conducting a detailed needs assessment of that new account holder. 45% are providing some sort of immediate follow-up. 20% are coming in 3 days later. 14% are doing some sort of follow-up. And then maybe 2 to 3 weeks after that account has been opened, we see only about 9% of financial institutions following up with those new account holders. But what J.D. Power is finding is that the customer satisfaction levels go up the more we increase, and that's portrayed in those numbers in the circles. So you can see as we go from left to right on the chart, the more financial institutions communicate and keep that process going with their account holders, the higher the level of satisfaction goes up. And that's certainly a good thing. Point number 5, we want to make sure that we're continuing to talk to the customer throughout the life cycle, not only within that first 90-day window when we're onboarding them, but we want to make sure that we're continuing that conversation with customers with members throughout their life stages while they're customers or members of our financial institution. We know in the blue box, on average, the typical banking or credit union consumer today has 9 financial products on average in their wallet. Unfortunately, only on average, 2.5 of those particular products happen to be with my financial institution. So there certainly is a lot of opportunity for me to go out there and reach out to my customers or my members with intelligent programs that are identifying the right customer at the right life stage with the right product and the right particular offer. And this slide really conveys a lot of that. Starting from left to right, we want to make sure that throughout this particular customer life cycle or member life cycle, from the acquisition stage all the way over to the left, as we continue the process, we want to make sure that we are continuing to communicate, we're cross-selling, we're conducting retention efforts with our let's say our most deeply ingrained customers, and that we're just making sure that we're communicating the right product at the right time to those particular customers. Another J.D. Power study on this chart, again, shows basically in a nutshell showing that when we are not engaging those customers in conversation, kind of conversely complementary to what we just talked about, when we do not ask questions, when we are not out there communicating with customers, what do we see? We see satisfaction levels in those green circles, according to J.D. Power, continuing to diminish. Point number 6, as we're communicating with our customers during the course of their life stages, let's look out at multiple reach-out efforts. Let's look at loan recapture opportunities. What do we know? We know that you can take a look at any of your particular loan portfolios, mortgage, home equity, auto, and on average, 20% of those particular loan portfolios, a thumbnail is 20% of whatever that number is will have a loan at another financial institution. So there's a lot of opportunity for us to reach out to our existing account holders and encourage them to refi a loan that is not with us, but is with another financial institution, refinance that loan with us. We know there are opportunities from a loan maturity perspective to communicate to particularly, let's say, our customers or our members who have borrowed money for an auto. There are certain times when we want to reach out to them. Typically, we want to look at 2 years into the loan and probably 30 to 60 days before the loan is paid off. Reach out to those particular account holders and encourage them to get another auto loan with us. Loan verification is another opportunity that very few financial institutions are taking advantage of today. It is monitoring our existing account holders and seeing where they are applying for loans, and then processes are in place today where we can immediately reach out to those particular account holders and pre-approve them or pre-qualify them for the particular loan that they happen to apply for. We receive a heads up from the particular credit bureau, and we work with all 3 credit bureaus for this. And we can reach out to those customers or members immediately and try to save the loan and encourage them to get that loan from the financial institution where they're already an account holder. Loan activation and loan utilization, we know that on average, 20 to 30% of HELOCs, for example, have a 0 balance. That always seems to be a very quick needle mover whenever those types of programs are conducted. So heads up, you may want to take a look at your HELOC portfolios, see what kind of balance your account holders have, and conduct programs that will encourage them to borrow more money. We don't have to encourage them to borrow money simply for the sake of borrowing money, but convey to those account holders the advantages, the benefits, the features of utilizing that home equity line of credit. And in many cases, we find that HELOC borrowers simply have forgotten how to use the product or may have misplaced their checks. So there's a lot of opportunity there. And then, of course, we want to continue to communicate with credit card holders. Same thing with HELOC borrowers. We want to encourage usage. We want to make sure that they're keeping that credit card top of mind and at the top of their wallet. Point number 7, let's not put all of our eggs in one basket. Oftentimes, I'll be out there and see financial institutions relying on one particular communication channel. The financial institutions whom I see are most effective, and I think Karen Benedetti will talk about this in a couple of minutes, are those that are communicating with members and potential members via a multiple of different communication channels, whether it be direct marketing, mail and email, the variety of media channels that are out there, radio, newspaper, television, billboards, utilizing public relations, utilizing word of mouth. Those financial institutions that are taking advantage of multiple channels and complementing the message, complementing the channels, are the ones who are certainly the most successful. Point number 8. There we go. If you're not focused on auto lending today, you need to be. And I'll show you a chart in a couple of seconds here, but what do we know? We know that there is a huge pent-up demand for autos today. In fact, according to R.L. Polk, an auto industry consultant based in Detroit, we know that the average age of vehicles on the road today is approaching 11 years of age. So there's a lot of old iron out there on the highways and the roadways. We also know that consumers are out there looking increasingly at luxury brands as well. So there's a huge pent-up demand out there for auto loans. In fact, this chart provided by R.L. Polk shows new vehicle sales, and this is only new vehicles. This is new vehicle sales in the United States. And what this chart is showing, if you go all the way over to the left, in 2007 there were 16.2 million new vehicles that were sold in the United States. Per R.L. Polk's analysis, look at how that number dived during the recession, bottomed out in 2009. In fact, it looks like we lost about a third of the overall market, if not more. And the market has been coming back. The expectation is by the end of 2012, we'll see almost 14 million new vehicles sold, and then in another 2 years, we'll see those vehicle levels back up to where they were pre-recession. So huge opportunity out there. If you're not looking at new auto lending, you need to be. Next point number 9. Consumers' financial obligations are at the lowest level today since any time before 1994. So we've got a lot of consumers in the United States who have cleaned up their balance sheets, who have unloaded themselves of any debt obligations, and it may be time for us to go back, and I hate to say this, but it may be time for us to go back and start doing a deeper dive on that paper that's coming into the financial institution. I know from experience in 2007, 2008, 2009, 2010, I was with a financial institution that was denying 7 out of every 10 loan applications that were coming in the door. Many of us took a very conservative approach during the recessionary period, and that was certainly the wisest of things to do. It kept many of us out of trouble. But as debt obligations have lightened up among consumers, this may be a good time to go back and take a look at that C&D paper that's coming in the door, take a look at approving those particular loans, making sure we're managing those loans appropriately, not letting them sit out there, but making sure that we're keeping both eyes firmly planted on those particular borrowers to make sure that they're staying in touch with their loan obligations. And then my last point is, if your lending process is not world-class, we need to make sure it is. We need to make sure that we're giving borrowers the proper channels through which they can apply for loans. We need to make sure that our underwriting process has to be the best in the market. We need to look at what our competition is. We need to make sure we're looking at what credit unions are doing, what auto dealers are doing, what banks are doing. Sometimes I'll run into financial institutions that will tell me they're taking 2 days or 3 days to turn a car loan around. Might be taking upwards of 4 days to turn an unsecured signature or personal loan around. We need to make sure that our underwriting process times are world-class, are best in the market, It is a world of immediacy these days, and it is all about the account holder experience. We just need to make sure that our lending process is as streamlined, as fast, as efficient, and as pleasurable for the account holder as it possibly can be. Because if we're not doing it, you can bet your bottom dollar there are other financial institutions that are out there. So let me wrap up my presentation. Here are 10 things best practices that I see going on out there. Utilizing business intelligence, not letting those MCIF systems gather dust, making sure marketing and retail are on the same page, putting marketing in touch responsible for loan growth, making sure that we're talking to our account holders from the very get-go, and making sure that we're talking to our account holders throughout their particular life cycles, making sure that we're not putting all our eggs in one basket, but utilizing multiple channels that are complementing one another, focusing on vehicle growth because the market is there, going back and taking a look at high-risk loans, and lastly, analyzing the overall lending process and making sure that it's world-class. So with that is the conclusion of my presentation, and I would like to kick this over now to Karen Benedetti. Karen, as she mentioned, is the Vice President of Marketing at Service Credit Union. So Karen, thank you very much for participating in today's presentation, and I will switch this over to you.
Thank you very much, Steve. We're going to focus certainly on loan programs today, but what I've heard, of course, is the importance of PR and certainly the cross-sell on the share or deposit side, depending whether you're a bank or a credit union. So we have a strategy of promoting our clear advantage, and under those clear advantages there are loan advantages and share or deposit advantages, which include, on the latter side, getting paid 2 days early, ATM rebates worldwide, and those are throughout our social media and our PR. So I'm putting those aside, focusing just on the loan side. Loans, actually, prior to my coming, I've been here about 7 years, all loans were the key driver to business. Now we've opened up to coming in through the front door, too, on deposits. But the strategy remains the same, that direct deposit is our lead promotion. So direct deposit is like the key to the kingdom at Service Credit Union. It gives you discounts on loan products. And through that came checking. Again, now we're doing checking directly. But we discount most loans 25 basis points stateside and 35 basis points overseas. As I said earlier, we have military members around the world. About 60% of our members are military. We have bases. We're on bases in Germany, many of our branches, and we also have a good deal of those soldiers deployed downrange or to Iraq and Afghanistan. So we're also very, very mobile. So we have basis point discounts, 25 and 35 respectively for direct deposit, and then we up those for seniors, low to moderate income, and actually go up to a full 100 basis point or a point or for active military deployed to a war zone. So we have our ongoing sort of seasonal promotions, but also we look for opportunities such as troop movement, and we have that unique base. I wanted to talk, and I jumped ahead. If you excuse me, I'm going to go back one. Okay. We market through a variety of mediums, as Steve was saying. Of course, that's key. We do print, outdoor, online, direct mail. Core promotions, the non-targeted ones, are through a combination of print, online, and outdoor. So we try to use many venues, and I'm going to show you quickly some ads that we're using for campaigns probably this first part of this year. Loan marketing is just about 40% of our core categories, about 37% actually. And our loans are a big part of our asset base, but we spend about 40% of our core budget on loan marketing. Auto loans are really a lead product for the credit union, and not only do we talk about rate, but we talk about rate matches, which have a longer shelf life, and I'll show you some examples of that. Our mortgage business has been strong. In fact, some months it's so strong that the pipeline's backed up. So I market that every few months just to keep us out there, to show that we have veteran opportunities. We have a whole host of stuff. We actually have mortgages throughout the United States. So I go out when we need to, and I pull back when we don't need to. And we've added a lot of targeting direct mail, and that's yielded successful results on the loan side, and we're getting more into that area. These are just a variety of featured auto loans, and the ads are adapted, featured auto ads, featured loan ads, excuse me, and they're adapted to various print and media formats. We have a variety of newspapers alone, so because we market around the world, so we have to conform to that. The red tag sale, people like a sale, and I would actually say that actually the results of this, we do a tremendous amount of back-end analysis, I will say, using all the Harland tools. But this has been successful. People like a deal. The deal is a rate that we've been running, but the red tag sale has been a very strong, people like a deal. We've had very successful Black Friday results, and I brought those kind of deal or price tag forward as we go into this 2012. The rate guarantee is on the right side of the page. There it doesn't matter. I also sit on the pricing committee, and we look at auto loans actually every 2 weeks, and we can change the rate. We do change the rate. And this gives a longer shelf life, and we do match rates. There's some disclosure about showing other sources, and you can get $100 if you can get a better rate somewhere else. So that's an ongoing promotion. The next page has additional loan ads. We talk about Visa, and in fact, we also have Design Your Own Card in our branches, which we feature in some of our ads. Depends where it is, and it depends. This one's military, where there may not be branches. But you can go into a branch, and actually you can either design your own card, which you can do at home online, or come into a branch and pick a card, get the design. There's a variety of designs, and get it issued to you on the spot. So we feature stateside, and where we have branches, you can get on the spot. And I think it's actually in this ad. We also do a lot of stuff to support the military. We have relocation loans, and we have unsecured loans. So we really look at a calendar. We have a marketing calendar. We talk about it. We try to understand what's important that time frame. And just very briefly, we've gotten into business lending, so we've carried that forward, and we're an SBA lender. We're really starting to pick up some traction in that area. The next slide, these are more branding, if you will. We talk about the clear advantages as a military one. We always make sure that the loan stuff is tucked in there. There are warrior rewards, actually, which you see about the fourth bullet down, talks about 10% APY on the savings side for warriors, but then we talk about the discounts as well. We're just hit our $2 billion mark, and I always make sure we tuck something in on autos, and you'll see Refi there. The Refi Promotion, I'm just going to talk about very briefly. We use that quite a bit when we open a new branch, and we've been opening new branches. So bring a loan over that you have, and we'll put $100 in your account. That has been our most successful in terms of new branch openings or the like. People will come for that. $100 is the old 25 or 50, and we have found that 100 will move the needle. We've also found that gift cards are more exciting than cash. People will use those gift cards. They won't let them go as part of their regular savings to pay bills. So gift cards are even stronger. Since we have members that are not near branches or we're trying to attract some, the gift cards are a little more challenging, but we do those. And you may or may not know, on the loan side, if you give a gift, you don't have to do any tax issuance unless you hit the $600 mark. And many deposit promotions where you have a member open an account or a customer and they give them $25, that triggers as a $10 trigger for taxes. So on the loan side, there's not. It's actually easier to give incentives. I'm not going to dwell on this, but we measure everything. We have unique phone numbers. We have unique URLs. We try to be as refined as possible, because we have a lot of marketing dollars and we have to move to a lot of venues. We are a bricks and clicks kind of credit union, so we want to have our ads because we will have our local branches, but we want to do online. We wanted to cut back on our ads, but we don't. So we really have to measure what works, and this was just one example of that. The next thing is now direct mail that I was going to talk about. We talked about sort of the mass marketing and now more the direct side. We have loans as part of our onboarding initiative. We have a pretty robust onboarding initiative where if a member comes in with just savings, we try to sell them checking. If they don't have direct deposit, we try to sell direct deposit. We try to build the entire core relationship through things like online services, and then we add a loan onto it. We have done primarily credit card, but we have done other loans as well, and that has been strong. We've had very successful results from onboarding. What you see in this visual is our auto maturity mailing, which Steve has discussed, and we've just rolled that out I'd say about a year ago, and that's been successful as well. And so we're going to members at about the 22-month mark and then closer to the 60-month maturity. This next slide just shows, and I covered up some of the dollars. I just wanted to come out with the numbers, but it shows that we have about 2% response rate at both at about 22 months and close to 60, but total responses, direct and indirect, which we've been successful on not only in this venue but also in our onboarding, exceed 6%. And that's always great about mail. You try to sell product A, but you're reminding your member or customer about all the other products, so you might sell product B, C, or D. So there's always an extra benefit that's unplanned, and we measure those as well. We are starting a Recapture program right now. We work through Harland Clarke. They introduced us to another partner of theirs that we are working with, and we are excited to do this. This is very targeted based on credit score and so on and so forth. The premise to this promotion is our members having auto loans elsewhere, and we will show them what the savings will be by moving their loan over to Service Credit Union. What I've been told is the magical number is about $30 a month. That'll get people to move. Now, we will go to non-members and use this as an acquisition tool, but we want to go to our existing members first, and we're just about ready to launch that program. So I can't talk to any results yet, but we are just about ready to launch that at Service Credit Union. Next, I wanted to talk about opportunistic marketing. If there's an event, leverage it. We've had huge success with Black Friday. We added Cyber Monday. We have a very mobile market, and so we wanted to get people online too. And some of the promotions are certainly in the kind of exciting deposit world. We have a 10% certificate. Now, it's 10% for 3 months, and I think it costs us $30 in dividends or interest if on the bank side. But we get people in the door, and the retention rates are huge, and I will show you that on the next page. We have about a 99 – this was from an overseas presentation, this page, so I should have removed that word overseas. So both overseas and stateside, both cases about a 99% retention rate. We open about 2,000 certificates, new CDs in half a day, and about 300 of those are new members, and we have a 99% retention rate. Then we get more out of them. They buy more afterwards because they've had a delightful experience, and they buy more afterwards. It's been a great promotion. We've done it for 3 years now. Opportunistic marketing. This is overseas. We really try to ingratiate ourselves with the dealers. This could happen stateside as well, but we've been focusing overseas, and so we do a lot of auto shows, and we capitalize on-site financing. We give an extra 10 basis points off. We always talk about low rates. We have our Match Plus program, as I mentioned, and quick decision, because we'll give on-the-spot decisions. And we do lots of e-blasts. This is a category. We do lots of e-blasts. And we're doing more and more e-blasts here. And really the last thing is I want to just talk about, on the military side, we have a unique market that's sort of a recession-proof market. It's about 60% of our member base, and there's constant transition. They are going from the U.S. to Germany, which is where we have our branches. They are transferred to the war zone. They're transferred back. So there could be, and then we've built metrics and models. They would be looking for an auto loan when they return. The biggest thing they want to buy is auto or motorcycle. When they're transferred, they want a relocation loan or they want an unsecured loan. So that's our targeting. That's not as much direct mail based, but local marketing based. And so we're able to look at that. And we are on the larger side in the credit union space, but a lot of these things can be done smaller scale by either picking a location or picking a venue. We have perhaps the luxury of testing different programs, but on the same hand, it's really this, the setup fee is a setup fee in many cases, and it's just how many iterations you do. We have to do many newspapers, so it's expensive, but a lot of our programs can be taken down to a smaller organization. And that is all I have to wrap up, and I will turn it back to our chair.
Thanks, Karen, Susan, and Steve. That was great. Fantastic information. Just information packed here. We're a little bit over time, so I want to be respectful of everybody's time, but we do have a few questions. We'll get to a couple of these real quick, and then we can go ahead and end the meeting. The first question I got, interesting one, it's about HARP 2.0, and the question reads that they've been reading quite a bit about the new HARP program that was announced just at the beginning of this year. And the question is, are you seeing much activity? Susan, I remember you mentioned in your presentation that you're seeing some HARP mailings, so I'll put you on the hook for this one. What kind of activity are you seeing with HARP 2.0? What can you tell us about that? Susan, are you there?
Sorry about that.
Okay.
Yes, we are seeing quite a bit of activity for HARP. I think one of the examples I showed was Wells Fargo, and they mention HARP. Mostly the way it's positioned is, you might not have realized that you qualify to refinance, but there's this new program. Please call us about it so we can tell you all the details.
Okay, fantastic. All right. We've got another question here about what banks are doing to encourage automatic payment of loans. Would any of our panelists like to field that question?
Well, I'll address it first. We offer a 10 basis point discount. So we have used discounts as a way to encourage this. So we do add, in certain programs, we add 10 basis points discount on the loan for the automatic payment.
And Karen, thank you. This is Steve, and with many of the financial institutions with whom I work, I see a similar type of approach where they're giving some sort of a rate discount, encouraging account holders to pay the loan through automatic payment.
And this is Susan, and that's all borne out in the direct marketing that we see. Chase is one of the few that's offering a $25 cash incentive for setting up automatic payment, but usually it's in the rate discount.
Okay. Okay, and then we've got one last question, and then we'll go ahead and end the session. Karen, this one's for you. One of our audience members is curious about how big your marketing department is and how many branches you have.
Our marketing department, I have, I think, 9 people. I actually have one person overseas. And I have to see how many branches we have. I think we have about 30 branches now. They're about half and half in New Hampshire and half overseas. It sounds large for an organization of about $2 billion, but when you market around the world, what I've done is sort of built my own internal agency. It was so expensive to resize ads, and we're in a tremendous amount of newspapers, so that was less expensive. I also have a website under me. I have sponsorships. We do a huge amount of sponsorships in the community. We're sort of one of those credit unions that's the first to step up and try to create a leadership position for more giving. So I have a sponsorships group. We have social media. So it's everything is here and everything is internal except for some expertise I might call on for like some TV development. So it sounds larger, but we don't outsource a lot.
Okay.
But I'd also be happy to answer any specific question too as a follow-up, as we all will on any of the programs.
Okay. Well, fantastic. Well, I want to thank our panelists today. Susan Wolf from Mintel, Comperemedia, Karen Benedetti from Service Credit Union, and Stephen Nikitas, who is a marketing strategist here at Harland Clarke. And for our audience, thank you so much for attending our session today. I really hope that you found it useful and that this helps you with your marketing programs. That's what we're striving to do. As you exit the webcast, it would be great for us if you can fill out just a short survey, 3 questions, to give us some feedback about how you found the information so we can make these things better moving forward. So again, this is Al Fontova, a product manager here at Harland Clarke Marketing Services. I want to thank all of you again for joining us for this event. We really do appreciate your time. And I hope everyone has a great day. Bye-bye.